Welcome to In the Harbor, the podcast where sports, leisure, and finance meet. I'm your host, Jason Johns, and I'm joined today by a new co-host, Rock Harbor's head of distribution, Scott Lindsay. Scott, how are you doing today?
Doing great, Jason. Yourself?
Well, no complaints on my end. Exciting time for sports this weekend.
Oh, absolutely. I can't think of a better time for my first podcast than to match it up with a couple great calls from last week's podcast with Rory taking home his first Masters and our very own Western Michigan Broncos bringing home the Natty.
Absolutely. Sean and I did predict the Western Michigan Broncos. I did tell Charlie offline that Rory was going to win.
A supposed pick. I got it.
Right. So it wasn't on recording, but I promise you it happened.
Well, excited to be here, to be part of the podcast, and certainly excited about today's guest.
Excellent. Well, we look forward to having you on again many times, I'm sure. Leading into today's guest is someone who's seen it all in the world of credit, Henry Peabody. Over nearly 25 years, he's managed multi-billion-dollar portfolios and worked with everyone from family offices to sophisticated endowments and foundations. What really makes Henry stand out for me and this podcast in particular is he started his career at an RIA, so he understands the day-to-day challenges advisors face. He's also a regular voice at Riverhead Research, where his weekly column breaks down credit and macro trends with clarity and a client-first mindset. In this episode, we'll dive into his perspective on today's credit markets, the link between credit and equity risk, and what advisors should really be looking at amid all this volatility. This is In the Harbor. We're glad you're here. Henry, welcome to the pod. Thank you for being here today.
Hey, thanks so much for having me. This is going to be great.
And, I think it's only appropriate with your fellow Bostonian, Scott Lindsay, as co-host. Let's walk into kind of your upbringing growing up in the harbor, as it were.
Yeah, I know you guys are big hockey fans there. So I did play hockey. I was a 5'0" center, and I used to get the what kicked out of me. So hockey's not my game, my friends, but I like to get out, play a little golf every now and again. I've decided that game is a lot easier when you play with my girlfriend's rule, which is no sand traps on the weekends. Makes life a lot easier.
No sand traps on the weekends. We're going to have to adopt that rule here.
It's a good one. It's a really good one.
Well, and I think it's safe to say, Henry, you're no longer 5'0".
I've grown in several directions.
All right, so hockey didn't pan out. Fortunately, the markets did. So what first drew you to macro and credit markets, and what's kept you engaged so long?
So long. Yeah, dating myself a little bit here. So I got first into the space in college. I was a macro, or I was an economics major, very much qualitative, not quantitative, and came out of school originally writing interest rate strategy, which is a great way to skin your knees and learn the hard way when you're wrong, when you've got an audience of people who are 10 times brighter than you. I've always been inclined to be on the macro rate credit side because I think there's just so much to explore. A lot of my friends went into equity analysis, and that was kind of the sexy thing. But the fun thing to me about credit markets and liquid markets is there's always something to learn. There's always something to do. There's always a mispricing. There's always a view to express. And it's not only a universal language that everyone speaks to some extent, maybe not the same level of detail, but it's a universal language. It can be applied to hedge funds. It can be applied to a very simple tactical asset allocation that a retail advisor might be using. So it's one of those things that's broad in nature and application. And I think that everyone should have an appreciation of the importance of it in their process. I think it's fascinating. It's to be a curious investor in this market. It's challenging, but it's really fascinating.
Yes, it keeps the variables keep changing. Sometimes the story rhymes a little bit,
Yeah.
but always new variables, which makes it interesting, and you have to constantly be thinking about things differently. So
Yeah.
in that vein, thinking of some of the prestigious asset managers you've worked for, how has that shaped your investment philosophy and kind of changed your processes?
I think I've had some great experiences, and I've worked with some really, really bright people, Scott notwithstanding. And what I've learned is, when you're thinking about active management, this is really in the public space. To succeed, I think you need a couple of really, really important things, and one of them is a breadth of mandate, and the other is a client base that is appreciative and in agreement with that type of strategy. And those are very, very hard to accomplish. Um, I think that the expectations of single asset class managers are likely too rosy, particularly in credit and equity. That would have been sacrilege to say a number of years ago, but I think the simple fact of the matter is, in many of these asset classes, the asset allocation decision is often more important than the manager selection. It doesn't apply everywhere, of course, but I think that what I've learned is to have that time horizon and be able to outperform over a long period. You need to deviate substantially from a benchmark, and that's very hard to do these days with so many alternatives to your strategy, top-down models, et cetera. And to be quite honest, that's really in line with why I started to think about doing this here at Riverhead, which is advisors have a really, really hard job, and they have a really, really important job. And I've never walked a mile in advisor shoes. I've worked with advisors my whole career. And just managing the relationship and working through those challenges is a full-time job. And what I've found is there are a lot of advisors who are in need of unbiased help, investment platform help, communication help, analytical help, and they very simply can't afford it. So this effort that I'm putting forth is a way to support advisors from an unbiased sense and to bring this experience from several asset management firms, the good, the bad, the ugly, and try to do my best to support them.
Yes, and I think as we transition, so for financial advisors specifically, how would you describe the credit market in simple, actionable terms?
So the credit market it's sort of the yin to the yang of equity. And every government, corporation, or frankly, individual has the right capital structure. They have a certain amount of equity and a certain amount of debt. And it's different from person to person, from corporation to corporation, from government to government. And the equity markets we know very well. You can raise public equity. You can build your own personal equity through earnings. The liability side of the balance sheet is where the credit markets come in to lend companies, governments, or even individuals money, capital through bonds, through securitization, through the banking system, et cetera. So that credit market is really enormous and expanding every day. And in it, there's a very complex set of securities that you can really build a lot of different things with to solve for different outcomes.
So, what's one thing you wish more advisors understood about fixed income and credit in portfolios?
Boy, there's a lot. One thing, I think we've grown up in a world where a correlation between equity and fixed income, equity and credit, was a given, and I think that's led to a lot of overconfidence. I think it's probably led to some risk being taken or put in places that it does not belong. Um, I think advisors would be well served to think critically about the role of fixed income and, frankly, the role of their entire portfolio and the expectations thereof, but that's another conversation. Um, the assumption is for negative correlation, and that did break a few years ago. We're seeing that again. I don't think anyone's calling for it to be renewed or completely unwound. I just don't think it's as stable as we assumed it to be. So to toss out a asset class by virtue of a correlation that didn't work out, I think is mistaken. And I think truthfully, what you're seeing right now is a sentiment that's awfully negative in equity and fixed income, and partially for good reason. But some of this is on the back of that correlation. And to me, certainly 6 months ago, when I started to write more aggressively about this, you can put together a bond portfolio that yields in the mid-single digits at 2/3 the expected return of equity. That's pretty good on the surface, right? Like, even without the expectation of it moving in an inverse way to equity, that's pretty good. And I think that we need to think about the purpose of this instrument in their portfolio, but also the number of roles it can play beyond just sitting there and trying to react to your equities.
So when I think about that, risk management within a client portfolio is something that's very important. But I think the number one thing is risk is the only thing you can really control. You can't control returns, but you can control how much risk you're taking and where you're taking it from.
Agreed. Absolutely. And I think that what you have to think about today is, what is your expected return going forward, and what is it composed of? And we've had a decade and change post GFC, and there's a lot to talk about there, of risk premia harvesting, and that's owning the S&P, and that's owning duration. And I think where we are now is very, very challenging, because those are not necessarily easy bets. Systematic risk is going to be, it's very challenging to feel very confident in an outright bet in one direction or the other, and we can get into that. But I think that there is going to be a great opportunity for alpha generation, because those strategies that can stretch a little bit, I think we're going to see a pretty fertile fishing ground for that.
And thinking about your latest piece from Riverhead, I think you came out on Saturday stating we are in investment purgatory. I thought that was an interesting line. Do you want to expand on what investment purgatory is?
So there's a lot more than probably what's there, and part of the challenge of writing a weekly, but also limiting it to 3 pages when you have a penchant for being verbose like me, is keeping things quick. It's having a almost ADD mindset at the same time as being focused. It's very hard to do. I find this to be one of the more challenging things I've ever done in my career. So I originally had a lot more here, and I cut it. Where that comes from is my family, and my family is quite strange. And when we get together, we play a game called Skittles. I don't know if you guys know this one. It's a board game where you pull a top, and the top spins and knocks down pins to score. My mother, who's certifiable, when you get to the other end of the high scoring end of the game, she calls that the inner sanctum. Don't ask me why, just go with it. But when it gets stuck in the rooms that is the low scoring area, where you start this top going before it goes into its death spiral, she calls purgatory. You get stuck in there and you can't go out, and you knock down the pins that actually subtract points from your score. It's terrible. You get laughed at almost as much as if you fling the top across the room and hit your aunt in the face with it. So this is the game of Skittles.
Is that speaking from experience and hitting your aunt in the face?
I wouldn't. No, of course not. The inner sanctum on the far end of the court, where you score all these points, you think of 60-40 and risk parity, Mag 7, 60-40, these things that just work, and you get in there and you don't have to think and you don't have to do anything. But to get there, you have to start in purgatory and figure out what the next wave of investment sort of ecosystem is. And where I think about that today is really in a matrix of government and corporate leverage. And where we are now, we've the consumer levered up, and we had the GFC, and then we had zero rates, which caused corporates to lever up. And then we had COVID, which pulled forward a ton of fiscal spending, I mean, the coordination between Fed and Treasury is something that we'll talk about in history books. These two crises, the GFC and COVID, compressed all this together such that we have a bloated balance sheet and we're undergoing a debate about essentially capital flows, is in essence what we're going through right now. And to me, I think you can make just as cogent a case for inflation to remain high and to punish duration and erode margins as you do a deflationary spat, depending on how the trade situation with Trump works out. So when I say purgatory, what I mean is there's no clear bias. I always like to think about how to best sort of stack the deck in my favor. It may not be substantially, but just slightly. Lean into this, lean away from that. To me, there's no clear bet to make being overweight duration interest rate risk or overweight equity risk. So to me, I have really compressed everything into idiosyncratic, bringing income forward, thinking about how to get returns today while maintaining liquidity for when you're out of purgatory and you get a better sense of what the next 3 to 5 to 10 years might look like, because it's very easy to get hauled off the field on a stretcher in this market with the potential volatility.
I think everyone has seen that recently, especially. What would be some signs to look for that we're transitioning one way or the other out of purgatory? I know everyone watches the Fed religiously. The reality is, in a high inflationary environment, raising rates is about the only tool the Fed has in their toolbox.
Yeah, I don't think you look for the Fed on this one. This is sort of, this breaks the mold a little bit. The Fed's not there to fix a supply side problem, which is essentially what tariffs are. With the inflation environment where it is, they can't be preemptive the way we've always experienced things, which has given rise to risk parity and things like that, and this negative correlation phenomenon, which has been just a boon for investors. So, and we may get back there, but right now the Fed really has to see the whites of the eyes of a slowdown to react, and I think that leads to the potential for volatility. The cop out is there's always a valuation component, and I don't think we're there yet. But I think what we're going to start to see over the next couple of years is corporate behavior. I think if corporations have a degree of understanding and faith on the direction of policy, whatever that direction may be, it gives them a window to commit productive capital. And if that's the case, I think we can move towards an environment that's really pretty amazing with productivity and AI and less growth driven by fiscal spending versus the last 10 to 15 years. And if that's the case, that's own equity and own businesses and finance them and feel pretty good. But if that's not the case, we're going to have the risk is another fiscal expansion, which can lead to some pretty tough places and bad choices. So I think I'm looking for signs from business, from private business, that they have a degree of confidence in the direction, whatever that is, to put capital to work.
So, Henry, let's expand upon that.
Yeah.
Think of it in terms of advisors and their clients now having that type of conversation, right? Mm-hmm. And putting capital to work. And it's not just a company. Yeah. What are the kinds of things, and maybe, there's some opportunities or some signs out in the marketplace that might be a little bit more directional, right? Are there any true canaries in the coal mine, so to speak, that we need to be leery of, as we think about putting that capital to work going forward?
Yeah, I mean, I think you're seeing some of them. The high yield market is seeing very little in the way of issuance. CLO spreads are starting to widen. Credit spreads are starting to widen. You've had this bout of nervousness and volatility in interest rates, and really for some time. And it's really shifting over to risk markets. And I don't want to be too hyperbolic, but what you saw last week in the performance of rates, equity, and currency was very much emblematic of capital leaving a market entirely. It felt like capital was being pulled out of the US. I don't know if that was happening. I suspect it will. So I suspect we're at the beginning of the process of finding a new equilibrium. And I think of advisors and sitting across the table from a client, and oftentimes this is not going to be the conversation they have, but I think it rhymes a little bit with a client's level of confidence in the economy. We're looking at survey data from places like the University of Michigan, right down the street from you guys, as well as the ISM, and both business and consumer sentiment have been, uh, to say they're in the toilet is generous. And I think that right now those sets of sentiment indicators are very much aligned around the same issues. And I suspect consumers will start to feel better after the bottoming in risk has occurred. But if they miss that little bottom, that's okay. And so I think a lot of advisors should be talking to their clients about their views of the economy, because right now it's actually really relevant, which it might not be in other cycles because there are other factors. This is a consumer and business driven cycle. This is confidence. This is putting capital to work. A consumer sitting across from an advisor is just as valuable as a data point in an economic survey at this moment in time.
So if we think about capital leaving the United States, when we saw this, heightened volatility, and it was really universal, it was across all asset classes. I think, when you look at the Treasury auction last week, some people were expecting that to be a lot worse than it actually was.
Yeah, we have this ability to kind of get ahead of ourselves, right? The Twitter effect, social media, we think they move a lot faster than they do, but folks who take part in those auctions have done so for generations. And I don't think you're going to see that turn on a dime. And the data we saw supported that. All that said, it's certainly worth watching. Volatility in the market led to the England canceling their long end auction. I don't recall that happening here, though you'd have to check my data on that one. It's not normal behavior. Right now, the auctions are going just fine. I think what we're going to have to start thinking about is the necessary impact of this trade shift, if indeed it does occur, and what it looks like. And the simple math here is that the fewer dollars we send abroad, the fewer dollars get recycled into our market and provide us with leverage to consume the world's goods. It's a system that's worked for a long, long time. We are the world's consumer, put very simply. And if we consume less of the world's goods, then we need to finance ourselves. And in the interim, any stimulus that occurs before those corrections have been made, if you believe in those corrections, stimulates the rest of the world rather than us, and it adds debt to our balance sheet. And we've just gotten to a point where it's beyond repair post-COVID. And I feel like COVID pulled a lot forward. We would be in this place anyway, but it would have taken a lot longer. It's a tough spot.
So, and thinking about it globally, what would you say? I mean, you look at the austerity measures that Germany announced. What would you say the movement in German bunds are telling us there?
So for years, Germany has had this debt break, right? It's a constitutional limit on the amount of debt and their carve outs and things like that. So Germany's often been seen as sort of the poster child for what loosening could happen in Europe and bring forth this spend. What we saw in, was it Q4, early Q1, with this discussion of Germany taking on or Europe taking on a lot larger portion of defense spending, was really a sort of a renewal of that argument. Germany yields in Germany backed up, I think 50 basis points or so, and have since collapsed, which is interesting because it's coincided with yields in the United States moving higher, which should tie in with dollar strength, but the dollar has actually sold off. So it's in this whole conversation around unexpected relationships coming out of the woodwork. I suspect we will see Germany flow through on their spending, because a lot of this toothpaste you just can't put back in the tube, rightly or wrongly. I'm not judging anything, but I think that this toothpaste doesn't go back in, and the die has been cast for a larger share of spend in Europe, which will be fascinating to watch, especially given the valuation discount in rest of the world versus or Europe versus US equity. So I think that's going to be really interesting.
So you brought up the dollar, Henry, and we know in certain periods a weaker dollar it can be a very positive thing.
Absolutely.
What's this environment for a weaker dollar, right? Some of the variables have changed. Some of the outputs are uncertain. Will it still follow this a similar pattern?
My gut is no, but that's a very low conviction view. What you see historically is it's called the dollar smile, where the dollar does well in poor economic conditions and a flight to quality, and good economic conditions because the returns here are good. The dollar tends to fade and weaken in global coordinated growth, and everyone is feeling good. They're not hoarding dollars for trade. They're lending freely. There's no one who's caught with their pants down with over a dollar liability like an emerging market country or something like that. So there's no working capital needs beyond which are supplied globally. So that's generally speaking a very good phenomenon, and the U.S. eats the inflationary impact of that with the weak dollar, as we have for a long time. That's precisely what we did not see recently, and 1 week does not a trend make. But and there is no obvious substitute here, so I don't know what the answer is of what it could, should, or will be. But one thing to me is fairly certain is that performance week isn't what we're used to seeing. And usually if you see a weakening dollar in a improving environment, you see EM rally, you see commodities rally, you see all these cyclical sectors rallying. But this was a dollar weakness in a risk-off environment. So your reflex when you hear negative dollar is rush to EM, but I don't think it's that easy right now, particularly because EM has seen several benefits, right? They've seen labor in Eastern Europe was a big boon. Before that, it was commodities, and it was China entering the WTO. These big secular changes that benefited capital going to emerging markets, which created a lot of this reflexive behavior. And if there is a big shame in this whole thing, it's that a lot of emerging markets that didn't get caught up in the demand for labor may now have that resource in less demand, and that's going to do a lot of that's going to harm, that's going to hurt socially. So I think that the jury's a little bit still out here, and it's something that you need to watch really, really closely.
So as we reflect on your thoughts on the market and what you're seeing specifically in global markets today, if you were a financial advisor, how would you think about allocating capital if you have dry powder to put to work, or positioning your portfolios vis-a-vis risk exposures?
I would be very conservative, as you might imagine. I would also be doing a lot of communication. And I think that investing, whether institutionally, as I have for 40 Act funds and large institutions, there's more of the job that's communication than you think going in. And I think advisors are the same way. There's going to be a lot of communication, a lot of explanation. There's going to be a lot of adjusting expectations that the last 10 years is probably atypical. So I would look to a lower rate of expected return and think about how to build that with a greater level of certainty. And it sounds like bias, but I do think intermediate and in fixed income is one of the no-brainer trades out there. The backup in the muni market seen over the past few weeks is really interesting. Munis are an instrument that holders tend not to, they tend to buy for income and not necessarily for that hedge. And 5% in the long end, if you believe in the tax efficiency of them remaining and all sorts of things, is a very interesting place to look for income. So I would be focusing on liquidity and on income because I think it's more reasonable to expect lower returns and an opportunity to put capital to work. And again, this is not turning a portfolio over. These are marginal considerations around a strategic allocation that advisors have. It's maybe you're not overweight US, maybe you add a little bit more to intermediate munis or credit to generate a little bit of income that can then be deployed. And I think it's just thinking strategically about that evolution of things.
Well, it's on paper, everything makes sense, right? This is what you're supposed to do when these things happen. In reality, not always the case, right? Getting out of the market, we saw this in '08. Getting out is very easy. Maybe talk a little bit more about having that plan per se to keep people engaged, or if they do come out of certain markets, how to leg back in. Because as we saw, we had great returns in 2009, 2010, 2011, and record levels of cash sitting on the sidelines, right? Just don't want people to have that amnesia that they're already having. That volatility exists.
You're absolutely right. And the last thing I would advocate is being a large scale market timer. I certainly can't do it. I don't think anyone else can. And as you say, I think it's much easier to sell than it is to buy. Me personally, this is just me. I have a ladder of crossover bonds in the 5 to 7 year range and in. And when one matures, I religiously look at what I have to do with that money and think about it's going to be locked up for the next handful of years. Where is the best opportunity at that moment in time? It creates a regiment for doing these things. And I think the more you can be regimented, the better off you are. I also think that the simple fact of the matter is once you look at expected relative returns, once you start seeing an appropriate risk premium to the equity market vis-a-vis credit, and if I believe in anything, and this is going to get overly complex, but a CAPM type of framework where you're going from expected return in risk-free, expected return in credit, expected return in equity, and you're laying in various risk factors, illiquidity, taxes, whatever it is. And those deviations and those relative expectations, I think, are the driver for asset allocation decisions. It's not going to be a macro signal. It's not going to be, there's going to be a sentiment component, but it's going to be just a reasonable expectation of what to earn in a certain asset class over the next 10, 15, 20 years. Is that compelling versus your alternatives? And it's an unapologetically objective exercise, and one that people are generally very bad at, which is the importance of advisors in this sense, because no one's going to get the timing right. What they want to do is just tilt the scales, just stack the deck a little bit in their favor and avoid unnecessary risk.
Well, in thinking about capital market assumptions, I think it's easy to forget. You look at the last 2 years for the equity market, we had 20 plus returns on the S&P 500. So if you were 2 years ago, you had a 10-year capital market expectation for U.S. equity, that's going to be revised down automatically because that wasn't a 20% a year on a 10-year number.
Absolutely. And I also think it's important, as much as we're looking at these markets, and there's hyperbole, and there's a psychological attachment to negative news, certainly over positive. We've studied these things. The long-term chart, this is really honestly a blip. And I don't think anyone's calling for picking up this chart and moving it up and to the right, but nobody's yelling fire in a movie theater right here. Let's just have perspective that there's going to be an expected return on equity and credit, fixed income, cash, commodities. And I think being diversified and beyond just a static 60-40 makes a ton of sense. And There's been a lot of money that's been raised by advisors, raised by asset managers, drawing fees on, that has relied on that relationship. And by God, I hope it continues, because it's been, it's been the second one of the world after, accrued interest, according to Buffett. I'd say that insurance policy paying you is just remarkable. If we can get to that spot again, I think it'd be fantastic. But right now, it's a little too murky, and I think it makes sense just to be very, very diversified with lots of sources of potential return and liquidity.
Henry, just one thing to add to that, and just curious your thoughts. The last 15 years have been their own little microcosm. Does everything hold up, right? In terms of, there's a lot of change coming at us. We've got a new administration. We had zero interest rates for a decade.
Yeah.
You have an ongoing active versus passive debate that seems to get pushed to the side. With all of this change, does the secular rotation still work within its confines and maybe get a little elongated? But are we still in a normalized business flow?
I'm going to say yes and no. It's a really, really good and interesting question, and one I didn't prep for. Listen, I think that the ebbs and flows of expected return on capital and the business cycle are certainly factors that will not go away. I think they're rooted in psychology and human behavior, greed, fear. There's no getting around that. I think we've been very fortunate over the last 15 years that monetary policy, and frankly then fiscal, as we've shifted to zero, has blunted that cycle. We haven't had many homegrown, run-of-the-mill recessions where bodies are carried off the field. And I look back in my career, and before I started, there was the S&L, and then there was LTCM and WorldCom, and then there was, the GFC, and then you had Europe commodities, and then you had COVID. And those were all met with massive policy responses, getting larger and larger and larger as if normalized, and the Overton window shifts to what became a wartime response in COVID. So we've had things blunted, which has built up excesses, and we don't have the scope right now to blunt the next one, unless we do, and we can stretch our balance sheet further, which is then becomes, where do we go next? But we don't have monetary headroom right now. I'd argue we're reducing our fiscal headroom as we speak by reducing the total addressable market of our debt, at least marginally. So we don't have that headroom. So I think we will have the you can't get rid of the business cycle. I think its blunting has been, or the ability to blunt it has been reduced. So I think what it adds in is actually the ability to think more critically about asset allocation. And it will also imply the likelihood that one or many of us will be wrong for a period of time, and we'll test that fortitude. So I think in a way, it's never been a better time to think creatively and to really be humble and not stuck on a dogma, because the way we're going to kind of get through this is together and thinking about these things creatively. There's going to be great opportunity for capital to be put to work, for productivity, for underlying our debt stack, for doing all these positive things. But I think the road to get there is something we've never really experienced, and I think it's going to take a lot of humility, a lot of egg on our faces, and are willing to get up off the mat and have these conversations and learn from one another.
Well, we certainly appreciate that insight, Henry, and I think it is interesting because there's a lot of unknowns out there, and we know how market likes uncertainty or doesn't like uncertainty. I think your purgatory analogy is interesting. You know, we could go one way, we could go another way. So I think taking some of your comments and thinking about what signs we'd look for that would indicate which direction we're going is definitely an interesting point to make. But Scott, you have any additional thoughts?
Well, I've been thinking about the purgatory room analysis, and my uncle and my dad's were all firefighters, right? And Jason's a firefighter. And I think of that analysis, and I do this every single day when I walk into a room because my dad taught it to me. But Jason, what's the first thing you look for when you walk into a room?
Exits.
The exits.
No kidding.
Right? And that's when that was the thought that was going through my head on the purgatory is, now the problem isn't they don't know which way to go. The problem is they never thought which way they might have to go. Right? You walk into a room, and the first thing I do, you find out where the exit are, you find out how close you have to get it, how many people are between me and that. I don't even think about it, right? It's just, that was my dad and a firefighter thing. So it's an interesting analysis, right? Because when I talk to teams, and Jason and I have these conversations, and last week I had a few advisors call me. And I said, not expecting a call today. And they're like, no, my folks know that this is okay. You know, we're going to get through this, right? Someone that's been out in front of their clients, and versus the proverbial, you can't get a hold of somebody because his phone's ringing off the hook. So the purgatory, it made me think, and then that was my thought process is it purgatory or was it lack of an escape plan?
That's really interesting to ponder. That's a really good analogy. And hey, thanks to you and your parents for doing that. That's remarkable.
Again, it's a firefighter
just
thing,
ingrained.
right? It's just
Just
ingrained in
habit.
your head. You just taught that when you were a kid.
I mean, I think the simple fact is we're going to go hard one way or hard another. And I don't think you want aggressive equity beta, and I don't think you want aggressive rate exposure, either one. I think you focus on the alpha away from the beta right now and watch. And I think your exit analogy is a great one. Have an exit plan so that you can approach the situation from a different angle, if need be. And hopefully you never need it.
Or at a minimum, what's the path of least resistance to extract myself?
Mm-hmm. Wow. Good one.
So, Scott, that brings up another thought from me, since you were talking about your family and childhood growing up. Are you familiar with this game, Skittles?
I can't say that I've had that game brought up in my family history.
It's you guys are welcome to come over sometime. There may or may not be empty bottles of wine scattered around the table. It's a lot of fun. It's a crowd pleaser.
If we were playing Skittles, it involved some brightly colored sugar candy, and there might have been some trading.
I think that makes sense too. Well, Henry, we really appreciate you coming on. I think for those of you listening at home, it's important to know where you can find Henry's newsletter. Again, he puts it out once a week. So that is Riverhead Research. I think riverhead-research.com, Henry?
That's correct.
Must read for anyone navigating markets right now, and you can hear more of Henry's thinking and as it changes, as we get new variables coming into the system on what seems like intraday now.
It's exhausting. Yeah, this has been a lot of fun, and thank you very much for having me. Likewise, your audience is welcome to reach out at info@riverhead-research.com, and happy to strike up a conversation anytime.
And again, just if you reach out to Henry, and I think this is important, it is unbiased views of the market, and that's a rare thing that we get in our industry today. And that's what I think I appreciate most about you, Henry, is there's nothing behind this. This is just your knowledge, experience, and expressing those views. So if you're looking for some unbiased views, definitely check out Henry on his weekly letter.
Absolutely. Thank you for joining us. This is In the Harbor. If you want to find us, we're wherever you listen to your podcasts. Thank you.